Hello, everybody. We are here at a new webinar at BBVA Switzerland. My name is José Andrés Martínez. I'm investment advisor, and here I am with Requena. He's head of third-party products and part of the investment strategy team. Here we are because we would like to present you one great opportunity, actually. Probably one of the best opportunities or investment opportunities ideas we have had in the last years. So, David, can we have a short brief of what this idea is about?
Yeah, sure, Jose. This idea is based on two synchronous movements. They typically occur every 20 or 30 years. On one hand, we have the Swiss franc, which we expect to be strong versus the US dollar. Okay. We actually forecast the Swiss franc multiplying by 2 the performance of the US dollar. And on the other hand, we expect a strong appreciation of commodity-related companies. In that sense, we are aiming at multiplying by 5-10 times our initial investment. So if we combine both ideas over a period of approximately 7 years, more or less, we think we could get a return of 30% per annum.
Wow, so sounds great.
Yeah.
So we will have these two combined ideas. So we already have some diversification between the idea within already, and we have the Swiss franc, which will appreciate by 2%, approximately by 2% or by 2 times, and the commodities investment companies, which will appreciate by 5 to 10 times. No. So, David, can we go a little bit deeper on the first idea, on the appreciation of the Swiss franc, please?
Of course. Here I would highlight this chart. Is the historical evolution of the Swiss franc versus the US dollar. So it's important to see that the Swiss franc is a very strong currency. It has been following an upward trend versus the US dollar. The red line in the chart is the average trend, which is approximately 3.5% of appreciation annually for the Swiss franc. And then the gray lines and the green lines show the first and second standard deviations from that red line. So key takeaway is when we touch the second standard deviation to the bottom line, the Swiss franc starts to depreciate.
Okay.
We have seen this movement already.
Okay.
It has started, and we are monitoring the evolution of the price, because once we hit the second standard deviation to the downside, we expect the entry point we are waiting for this movement. We expect a very strong Swiss franc for the long run versus the US dollar.
Yeah. And what about the commodities idea? How is this about?
That's the second leg of the idea, and here we like to present this chart. This chart is the relative performance of the commodity-related companies versus the global stock market. We tend to believe that the global stock market is always like the best place to be in. It's always appreciating, but it is true that in some movements, some niche markets, they do much better. And that's the example of commodity companies. Once again, the red line is the first standard deviation to the upside, and the green line is the first standard deviation to the downside. When we touch the red line, it usually means there is a bubble in the global markets. We have seen it several times in history, more recently in the 2000s with the technological bubble, or last year with the FANG stocks, that were everywhere around, people very keen on investing in those Apple, Amazon, Google, etc. So we touched that red line, and for us, this is a signal that commodity-related companies are going to outperform remarkably versus the global stock market. The movement has already started. We will wait for an entry point that we will discuss probably further into the presentation. But this is the second leg, and a great, we think, opportunity to combine with the other one.
So to have it clear, as I understood, the market in general outperforms the commodity-related companies sometimes, and it reaches certain levels where there is a bubble, and then the commodity-related companies from that moment. And looks like we are close to that moment, or we are already in that moment.
Yeah,
So
we've seen strong months
yeah,
from commodity-related companies recently.
yeah. But anyway, they are pretty undervalued. So
Yeah.
there is a good opportunity still there. So yeah, so sounds very good to me. And David, have we seen this idea combined any time in the past? You have already talked about it. We have already seen this idea in the past,
Yeah.
and how it performed, how it went.
Yeah, that's usually a very good question, just to picture how it could be going forward. For example, in the year 2000, we saw the Swiss franc starting this upward trend versus the US dollar for many years. And we also saw a period of time, basically from the 2000s until 2008, where commodity companies did much better than the stock market. In that occasion, over a period of 7 years, we would have multiplied our money 19 times.
Wow. 19 times. I think, or we are probably not aiming for that, no?
It's obviously a big number.
Yeah, it's ambitious.
It's ambitious. We mentioned 5-10 times before,
Okay.
and I think that's a reasonable scenario.
Yeah, and that will make this 30% we said at the beginning of the presentation.
Yes.
for the following 5 to 7 years.
Exactly.
So yeah, anyways, it's a great opportunity and of course a great potential idea. No? I'm sure many of our clients have many questions about it. I also have some. So what if we have a quick review of this question, just going to the end of the webinar. Before going to these questions, I would like to know how can we execute this idea? How are we going to implement it? Are we going to already buy this idea, or or the market is still not prepared for that?
We have to wait a little bit, Jose. We have to wait. We are not there yet. We are seeing the two legs of this main idea coming to the point that we like, but we need to be a little bit patient still. For the Swiss franc, we expect a fall between 10-15%. We think the dollar has still some room to outperform the Swiss franc. So there, as I mentioned, 10-15% still of decline for the Swiss franc. And on the other side, for commodity prices, we are in a difficult year. We have seen a lot of turmoil in the market. We have seen war, we have seen shortages, bottlenecks. There is a lot of volatility. A sharp correction is not out of the books. It could happen.
Yeah.
And if that happens, commodity companies should be cheaper than they are now, and indeed a better entry point.
Yeah, actually, the entry point is always important in businesses. So, they said so, no? The business is made at the entry point when you buy cheap something. No?
Yeah. And
then you have the greater potential to make the business for it. So, some quick question going forward. So, we already said that it's not the moment. We are waiting for a depreciation of the Swiss franc. We are waiting also for some falls in the market, some depreciation in the equity markets to get into the commodities related companies. So when we estimate we can have these movements, approximately, of course.
Yeah. It's hard to predict. We have some leading indicators that point that we should see both movements coming to the points that we expect within the next 12 months.
Okay.
So it's key to be active, to monitor the market, but that would be my guess.
Okay. And what happened if the history doesn't repeat, like we have seen in other episodes, and this time we are mistaken, and the market of this idea doesn't perform by 5 or 10 times, as we are trying to predict here?
It's smart to think about that. We always analyze all the scenarios when we present an idea to our clients, and that's why we are waiting. Jose, that's why we are waiting. We saw commodity companies already performing well in recent months, but yet we are still for a correction. We still wait for really, really cheaper prices, historically wise, and the same for the Swiss franc. So the fact that we are waiting those 12 months, the fact that we have entry points 0.90 for the Swiss franc, or cheaper prices for commodities, we believe that reduces the risk and also increases the potential. So I would say the risk is very, very limited when we wait patiently for the good moment to jump in.
Yeah, the risk is limited then. Yeah, that's important. And well, what if I, as an investor, cannot wait for these 5 to 7 years for the idea to perform? What if I have to leave the investment before? And do I have a risk? Can I withdraw my investment?
Also a key question. We understand that our investors can have some needs during those 7 years. Obviously, 7 years approximately is the time we think the idea needs to mature to see its greatest potential. But obviously, all the investment we are going to do are diversified, first of all, and extremely liquid. So if a client wants to withdraw the money, as you mentioned, Jose, we can do it in 24 hours. Okay. Everything has a secondary price. Everything can be traded within 1 day.
So there is daily liquidity,
of course,
and the investment is highly liquid.
Yeah.
Great. And so we already talked in this idea for the following 12 months. But what until then? What are we going to make with the money before? Should I keep it in liquidity? Should I put it invested in some other idea?
Yeah, that's a very reasonable question indeed. You know, and our clients know that interest rates have been rising recently, and we come from years where fixed income was an asset, typically conservative, but we couldn't get any returns because interest rates were extremely low. But this has changed. Now we can find investment-grade bonds with a very high credit rating that pay us a yield of 5%. You know, bonds like Apple, Amazon, Coca-Cola, really remarkable companies that have no default risk. So the idea is to jump into those, get this return, capitalize our money, don't waste time, and while we wait for those entry points we mentioned before, we are in a very conservative asset without default risk and with a very good return we haven't seen some years ago.
Yeah, actually, I see clearly there the trend, because if we hope or we wait until interest rates drop, is probably the moment where equities are going to drop as well. So we are going to take this value from fixed income and put it onto equities in lower valuation.
Correct. That's
so, well, it makes totally sense to me. And what happened to the portfolio invested in when the portfolio is already invested in this idea? I mean, shall we just put it and wait for the 5 to 7 years to come, or there is going to be risk managed somehow?
Yeah, I would say it's not a buy and hold idea.
Okay.
Active management is key. Obviously, we are, first of all, because we need to monitor some indicators to find out where or when is the moment to start. And once we start, financial markets have proven themselves to be unpredictable. So it can happen that we start in that idea, some companies or some products go overvalued, then we decide to reduce risk to add protection to the portfolio. So we are going to be managing that, and it's important to be very active during those 7 years of the investment.
Okay, great. Yeah, I can really understand. Well, just to sum up the opportunity, I would like to go a little bit for the main points. I think we have 5 points to go. First of all, it's a great investment opportunity idea. We have the potential to multiply by 5 to 10 times our investment. It can go higher, like in previous episodes, but well, that's probably too much. The second idea is that it have already passed in the past. It have already occurred in the past, this idea. And every 20 to 30 years, it repeats. So even if we are mistaken this time, we are going to get into the investment low valuation, so the risk is lower as well, which is one of the is the fifth points too. The third point is that we are going to manage the entry points. So we are going to try to get into the best valuations of every idea in the Swiss franc and in the company commodities related companies as well. And of course, the idea is totally liquid, so we have 24 hours liquidity for the investment idea, and every investment can be undone in 24 hours. So thank you very much. I would like you to thank you for your time. I would like to really thank David for his time and his great presentation.
Thank you, Jose, and thank you to our clients for the time.
Yeah, I will invite you, if you have any additional question, to go with your relationship manager, with your investment advisor, to any further question. Thank you.